In the traditional financial system, transactions can be reversed or meddled with by third parties, and transaction costs can add up. Bitcoin was presented as a way to transact without using a third party. Basically, transactions can go directly from one person to another, but at the same time, to be discreet, it goes through everyone at the same time. On January 3rd, 2009, the blockchain was launched when the first block, called the Genesis block, was mined. The first test transaction took place about 1 week later. Then, in 2011, miners and coders started to build other networks like Ethereum and Litecoin and began to improve the code behind Bitcoin's blockchain, adapting it for different uses. This wider base of applications brought in more individuals, which contributed partly to the increase in Bitcoin's perceived value. Once Bitcoin became available on exchanges in 2010, it became easier to buy, sell, trade, and store. Thanks to these exchanges, Bitcoin has a reliable price against the US dollar. It even has been officially adopted as legal tender in El Salvador and the Central African Republic alongside the dollar. February 2011, Bitcoin's price crossed the $1 threshold. Almost 2 years later, in April 2013, Bitcoin reached $200. By the end of November the same year, it was worth more than $1,000. It then rose to $10,000 in November 2017 and all the way up to its maximum price near $68,990 in November 2021. Today, one Bitcoin is worth about $30,000. It's a long way from its all-time high, but also a long way from its post-peak bottom in 2018 of just over $3,000. The identity of the creator of Bitcoin remains a mystery. To this day, no one knows who Satoshi Nakamoto is or was. It's a subject not only for debate, but speculation and perhaps conspiracy theories. Blockchain is a system of recording information in a way that makes it difficult or impossible to change, hack, or cheat the system. A blockchain is essentially a digital ledger of transactions that is duplicated and distributed across the entire network of computer system on the blockchain. As a database, a blockchain stores information electronically in digital format. Blockchains are best known for their crucial role in cryptocurrency systems, such as Bitcoin, for maintaining a secure and decentralized record of transactions. The innovation with the blockchain is that it guarantees the fidelity and security of a record of data and generates trust without the need for a trusted third party. One key difference between a typical database and a blockchain is how the data is structured. A database usually structures its data into tables, whereas a blockchain, like its name implies, structures its data into chunks, blocks, that are strung together. A blockchain basically collects information together in groups, known as blocks, that hold sets of information. Blocks have certain storage capacities, and when filled, are closed and linked to the previous filled block, forming a chain of data known as blockchain. All new information that follows that freshly added block is compiled into a newly formed block that will then also be added to the chain once filled. The goal of blockchain is to allow digital information to be recorded and distributed, but not edited. In this way, a blockchain is the foundation for immutable ledgers or records of transactions that cannot be altered, deleted, or destroyed. This is why blockchains are also known as distributed ledger technology, DLT. Imagine that a company owns a server farm with 10,000 computers used to maintain a database holding all of its clients' account information. This company owns a warehouse building that contains all of these computers under one roof and has full control of each of these computers and all of the information contained within them. This, however, provides a single point of failure. What happens if the electricity at the location goes out? What if its internet connection is severed? What if it burns to the ground? What if a bad actor erases everything with a single keystroke? In any case, the data is lost or corrupted. What a blockchain does is to allow the data held in the database to be spread out among several network nodes at various locations. This not only creates redundancy but also maintains the fidelity of the data stored therein. If somebody tries to alter a record at one instance of the database, the other nodes would not be altered and thus would prevent a bad actor from doing so. This system helps to establish an exact and transparent order of events. This way, no single node within the network can alter information held within it. Because of this, the information and history, such as of transactions of a cryptocurrency, are irreversible. Such a record could be a list of transactions, such as with a cryptocurrency, but it also is possible for a blockchain to hold a variety of other information, like legal contracts, state identifications, or a company's product inventory. Bitcoin is the first coin and it has the biggest blockchain. No one produces it, no one can burn it. It fully depends on people. Ethereum. Ethereum is a decentralized blockchain platform that creates a peer-to-peer network for the secure execution and verification of smart contracts, which are pieces of application code. It is the world's most popular blockchain-based platform for developing decentralized apps powered by smart contracts. Smart contracts are computer programs that take the necessary activity to complete a multi-party agreement on the internet automatically. The goal of Ethereum is to create an alternative protocol for building decentralized applications, with a different set of trade-offs that we believe will be very useful for a wide range of decentralized applications. And the ability of different applications to work together is important. BNB. It is an official coin of Binance Exchange. Use BNB to pay for goods and services, settle transaction fees on Binance Smart Chain, participate in exclusive token sales, and more. XPR. XPR is a cryptocurrency token designed to migrate transactions from central databases controlled by financial institutions to a more open infrastructure while significantly cutting costs. XPR transactions are trustless, instant, and cheap, putting them at an advantage for cross-border movements. It was launched in 2012. The cryptocurrency has one of the most ambitious goals in the cryptocurrency space. The software enabling the use of XPR, the XPR ledger, proposed a new way of operating blockchains that proponents claim is more suitable for transactions. Solana. Solana is one of the hottest blockchains in 2021 due to its incredible speed and extremely cheap transaction costs. This means Solana can support a huge number of decentralized applications without slowing down or having extremely high transaction costs. Solana is taking on one of the biggest challenges with existing blockchains: scalability. Designed from the ground up to be able to process over 50,000 transactions per second, Solana is built with scalability and speed in mind. This directly competes with other payment systems like PayPal or Visa. On top of this, Solana can achieve sub-second confirmation time, meaning users do not have to wait for their transactions to be confirmed. This makes Solana an ideal blockchain for decentralized finance and trading, as traders demand near-instant trade times. Cardano. Cardano is one of the biggest cryptocurrencies by market cap. It's designed to be a flexible, sustainable, and scalable blockchain platform for running smart contracts, which will allow the development of a wide range of decentralized finance apps, new crypto tokens, games, and more. Decentralized cryptocurrency networks need to make sure that nobody spends the same money twice without a central authority like Visa or PayPal in the middle. To accomplish this, they use a consensus mechanism. The original crypto consensus mechanism is called proof of work. first popularized by Bitcoin mining. The Cardano blockchain is also divided into two separate layers, the Cardano settlement layer and the Cardano computing layer. The Cardano settlement layer contains the ledger of accounts and balances. The Cardano computing layer is where all the computation for apps running on the blockchain are executed via the operations of smart contracts. Fundamental analysis is one of two major methods of market analysis, with the other one being technical analysis. While technical traders will take all the information they need to trade from charts, fundamental traders look at factors outside of the price movements of the asset itself. Fundamental analysis attempts to measure a security's intrinsic value by examining related economic and financial factors, including the balance sheet, strategic initiatives, microeconomic indicators, and consumer behavior. Basically, it analyzes the factors that could influence coin's price in the future. This form of analysis is based on external events and influences, as well as financial statements and industry trends. Pros of fundamental analysis. There are various tools and techniques that can be used for fundamental analysis, but they have been categorized into two groups: top-down analysis and bottom-up analysis. Top-down analysis takes a broader view of the economy, starting with the entire market before narrowing down into a sector, industry, and finally a specific company. Conversely, bottom-up analysis starts with a specific stock and widens out to consider all the factors that impacts its price. By basing these decisions on financial data, there is limited room for personal biases. Rather than establishing entry and exit points, fundamental analysis seeks to understand the value of an asset so that traders can take a much longer-term view of the market. Once the trader has determined the numerical value for the asset, they can compare it to the current market price to assess whether the asset is over or undervalued. The aim is to then profit from the market corrections. Cons of fundamental analysis. Fundamental analysis can be time-consuming. It requires multiple areas of analysis, which can make the process extremely complicated. As fundamental analysis takes a much longer-term view of the market, the results of the findings are not suitable for quick decisions. Traders have to create a methodology for entering and exiting trades in the short term might be better suited for technical analysis. In fundamental analysis, it is also important to consider the best and the worst case scenario. Even though it provides a more well-rounded view of the market, it is still possible for negative economic, political, or legislative changes to surprise markets. Technical analysis. Technical analysis is examining and predicting price movements in the financial markets by using historical price charts and market statistics. It is based on the idea that if a trader can identify previous market patterns, they can form a fairly accurate prediction of future price trajectories. Pros of technical analysis. Being able to identify the signals for price trends in the market is a key component of any trading strategy. All traders need to work out a methodology for locating the best entry and exit points in the market, and using technical analysis tools is a very popular way of doing so. In fact, technical analysis tools are so commonly used that many believe they have created self-fulfilling trading rules. As more and more traders use the same indicators to find support and resistance levels, there will be more buyers and sellers congregated around the same price points, and the pattern will inevitably be repeated. Cons of technical analysis. There will always be an element of market behavior that is unpredictable. There is no definitive guarantee that any form of analysis, technical or fundamental, will be 100% accurate. Although historical price patterns give us an insight into an asset's likely price trajectory, there is no promise of success. Traders should use a range of indicators and analysis tools to get the highest level of assurance possible and have a risk management strategy in place to protect against adverse movements. Why we trade cryptocurrencies? Cryptocurrencies are a form of virtual currency. Its purpose is to function as a medium of exchange, making it the same as regular money in many regards. The normal fiat currency, everyone knows, is controlled by the banks and the governments, and altogether you have no control on this. This is where cryptocurrencies are different. They work on the concept that the cryptocurrency is decentralized and works through a blockchain, a public transaction database which functions as a distributed ledger. So why do we trade cryptocurrencies? First reason is location. You can trade cryptocurrency from anywhere on this planet, and a person in France can trade their crypto coins with a person that sits in Chile or Antarctica. Since the price and rates of the cryptocurrency are not related to the country someone is sitting in, the local economy is not related. Second reason is volatility. It is very volatile. The price moves sometimes faster than on regular forex, and when it moves, it is able to move much more than in regular forex. This makes sense, as in forex, the price is related to an economy, and for a currency to double or collapse, some enormous dramatic events have to be taken place. Third reason is trading hours. It can be traded 24/7. Trading cryptocurrency wholly depends on an individual trader and not on time. That is what sets it apart from, for example, the stocks that can only be traded during normal business hours of the stock exchange. There are, of course, many more reasons, but these are the operational reasons that set the cryptocurrencies apart from the forex and other financial instruments that are able to trade online.